Hey team, welcome back to the channel. What do you call a masochist with a notepad? Subscribe! Make sure to do that, and let's hop right into the video. So in the previous video, we looked at how to obtain your credit report for free every week now through April of next year. So make sure to check that out if you haven't. But today, I want to talk to you about what makes up your credit score and the big factors on your credit report. So if you look here on the screen, I've got directly from Experian, one of the credit reporting agencies, what they factor into the score. And this is pretty standard across the board. So I want to show you this and give you a few examples that I think will be helpful. So let's take a look here first. So very first on the list and the most important factor in your credit report and score is your payment history. So as it says here, even one missed payment can have a negative impact on your score. And it will last for years, just that one hit. So you've got to be really careful here. Lenders want to make sure that you're going to pay back your debt on time, and this is a huge factor when they determine whether or not to lend to you in the future. As you can see here, payment history accounts for 35% of your FICO score. So let's take a quick look at what this looks like on your credit report, because hopefully this will help you decipher what you're seeing. So here's just an example. So on your credit report, if you go to the site referenced in that prior video, this is what it looks like from TransUnion. TransUnion's layout is a little bit more friendly for me to demonstrate this to you. So if you look here, this is a single credit card, and it says here various factors about this account. So date opened 7/24/2012. So that was 8 years ago. So this would be great to have on your credit report because of the history with it, long history. So that's good. You can see when it was updated. So this is an image that's old, but it was updated in April with a payment that was made in April as well. You can see the payment status. So current means that it's being paid as agreed. You'd see here 30, 60, 90 days late if it was in arrears. But this account's current, and you can see it's an individual account, not a joint account, and it's a revolving credit card. So there's different types of credit. You have revolving credit, which means that you can come back to it. So think about like a credit card where you have an open line of credit and you can utilize it whenever. Then you have a closed-end line of credit or an installment line of credit, like a typical auto loan or a mortgage. So that's sort of the differentiation here. When they're looking at your factors here, they like to see in your mix that you have more installment than revolving or a better balance between the two. We'll talk more in a sec on that. So here you can see the high balances when they happened on the credit card, and you can also see what the limit is or was. And you can see this limit has been increased a couple different times on this credit card, which is good. Having a higher limit means that if you have a higher balance, you're not utilizing as much of your available credit. So just here again, payment history, you can see going back. So April was the last month reported in this one. So this is a May credit report. And you can see, okay, that means that it was paid as agreed. And so it's okay all the way across the board back into 2018. And you'd see in your report that this would go all the way back to the opening date of the credit card. So just an example, this is how to read it. You can see balance, what the expected payment was, and any amount past due. So let's go back. Next, credit utilization. So your credit utilization ratio looks at your total credit available, so the sum of all of your open credit facilities that you have available, and then it's going to take what you're currently using on those, and it's going to have a ratio. And so this gives the lenders a picture of how reliant are you on credit versus being able to pay for things upfront when you purchase them. So this says very clearly here for you, using more than 30% of your available credit is a negative to creditors. credit utilization accounts for 30% of your FICO score. So again, this is another huge one. A third of your score almost is just this utilization. So you want to use 30% of your available credit or less. So let me just give you an example here. So I've made up this table, and you've got credit cards here, credit card 1, 2, 3, 4, 5. And so you can make a simple table like this yourself too if you have access to spreadsheet software, which is very common, just prepackaged with your computer. Microsoft Excel is the one that most people are familiar with. So just list the limits, and then you can do a balance here of what your current balance is, and then you would just take and you would make your balance, your current balance, your numerator, and then the denominator is your limit. So you can see then what percent you're using. So here you can see on this credit card, it's a $6,000 limit with a $6,000 balance at 100% utilization. So that's going to have a pretty significant impact that's unfavorable on your credit report and score. Likewise, here you can see with a higher limit, but the same balance, it's only using 2/3 of that. So that's going to be slightly better. And then with a higher limit here, even still with a $15,000 limit on these and the same balance, it's only using 40%. So a couple things that we can take away from here. One, you can see that with the same amount utilized on the line, the higher balance or the higher credit limit related to your balance is going to help you out a lot. So if you can increase your credit limit, that decreases this utilization. So that's a really good thing. You can call up your lender and request a credit limit increase. Sometimes they're going to want to do a hard pull, which can affect your credit. But if you have a good history with them, they might just do it for you. So that's something to consider. But if this was your credit card profile, what you'd want to consider doing is paying down the ones that are the higher utilization. This will have a bigger impact to your score. Now, maybe they have a lower interest rate, but for the sake of your score, if you're trying to juice your score for a purchase in the near term, really improving your utilization is the one lever you have that has a huge impact and can be affected in the short term. Payment history is the biggest factor, but it's also the one that takes the longest for you to be able to impact. This takes years of making good payments across your lifetime. So it's one that you can't make a short-term boost to. But if you went in here and you had the money and you could say, okay, on these two, I'm going to focus and try and get these down to say 2,000. That gets you close to that 30% mark, and it really will juice up that score. So I know it's a lot of money here on the screen, but just as an example of what you can do. So something like that in the near term can give you a big boost. And this is something that a lot of mortgage companies recommend you do if you're considering purchasing a home, because that 1 or 2 point difference that something like this can make, or 5 or 10, will really help improve the rates available to you on those huge purchases like a mortgage. Okay. Next is credit history length. So payment history and credit history length are kind of related, except credit history length is the age of your oldest credit account, the age of your newest account, and the average age of your accounts. So it really is your history as far as time of having accounts versus how you've paid on them. So this is another one. It makes up 15% of your score, but the only way that you can really impact this is through having an extended period of time, having open lines of credit, and then not opening too many more that will pull down your average. So if you have one card that you've had for 10 years, and then you have two that you've opened up in the last year, those two are going to drag that average down by quite a bit. So you want to have your oldest accounts open, don't let them close. So make sure that you keep doing transactions on them, even if it's just every couple of months, something small like a pack of gum, just to keep it open and active and showing you payment history. Because this one is not one that you can affect in the short term. It only will be changed over a long period of time. So again, big ways to impact this one, having that long history with an account and then not opening up too many new accounts in the short term, especially if you're going to be making a purchase in the next 6 to 12 months. Okay, number 4 here is credit mix. So I touched on this briefly a little bit earlier. Credit mix has to do with what kinds of lines of credit you have open. So do you have a mortgage open? Do you have an auto loan? Do you have a credit card? What type of credit card is that? So read through this real carefully here. I'll read it with you. People with top scores often carry a diverse portfolio of credit accounts, which might include a car loan, credit card, student loan, mortgage, or other credit products. Credit scoring models consider the types of accounts and how many of each you have as an indication of how well you manage a wide range of credit products. Credit mix accounts for 10% of your FICO score. So this isn't as big of a one, but this one is one that you have direct control over. So it favors you having a mortgage, a car, even student loans. It doesn't like credit cards as much, but it doesn't want you to have credit cards at zero. So it can be really complicated. You do want to have a few credit cards, but it hates store credit cards. I can't reiterate this one enough. It really hates store credit cards because it thinks of those as being a poor behavioral indicator. So whether that's Express or the Gap or anything like that. Anytime you go to one of those stores and they're like, oh, we'll give you this offer, discount, whatever, if you open up the store credit card, don't do it. It's one of the worst things for your mix portion of your credit score, and it will drag that down. If you have one or two, it's okay. Some of the bigger ones like Home Depot or Lowe's, those are ones that have a pretty good benefit if you're making like a big home improvement purchase. But keep it to just one or two of those store credit cards. You really want to focus more on your standard bank credit cards, so like a Chase or an American Express or Bank of America, US Bank, those kind of big banking institutions, because they have tighter standards. Having a card with them demonstrates that they think that you are credit worthy. And so that's actually good for you. Just like working for a big company can be good on your resume because people see it and think, oh, wow, well, if they liked him, then he's good. Kind of the same impact here on your credit mix. So keep that in mind. And then finally here, new credit. So the number of accounts you've opened recently, as well as hard inquiries when you apply, make up 10% of your score. So you don't want to have too many inquiries all at once or in a short period of time, and you don't want to have a ton of new accounts coming into your credit profile. I know a lot of people like credit card churning, myself included, but you have to be disciplined with that and really monitoring it. Hard inquiries stay on your credit report for 2 years. And so if you have a bunch of them, that's going to pull you down. Again, this isn't as big of an impact to your score. It's only 10%, so it's a low impact factor. But because it is 10% still, it can be that difference between you being at, say, a 730 and a 750. And the 740 area is kind of that cutoff for the excellent scores down to just good or very good. And so that can make a big difference when it comes to those larger purchases. So always be thinking about what kind of purchases you want to make. If you're looking at a mortgage or a car in the near future, pull back on everything else that you're doing. Kind of take a look at that utilization and your ratios, and then make some adjustments there so that you'll be all squared away for the big purchase. So hopefully you found this to be helpful. If this is the kind of content that you like, make sure to like the video and subscribe and hit the bell. And let me know in the comments what else you'd like to hear about. I've got a lot of topics in mind for the next couple of videos, but I'd like to hear from you because really this channel isn't for me, it's for you. I want to increase the financial education of everyone out there. So share the video to anyone you think this might benefit, and I hope I see you next time.